Imagine waking up one day to find that the money you worked so hard for hasn't just stayed the same. It's actually growing while you slept. This isn't a dream reserved for the wealthy or financial experts. Investing is the key that opens the door to financial freedom, yet so many people shy away from it, thinking it's complicated or risky. The truth is, investing is for everyone, and the earlier you start, the more powerful it becomes. Today, we're going to break down the basics of investing in a way that anyone can understand, no matter your age, background, or income. By the end of this, you'll have a clear picture of how to make your money work for you instead of just sitting idle in a bank account. Before we dive into the types of investments and strategies, it's crucial to understand why investing matters. Simply putting your money in a savings account isn't enough. Inflation is constantly eating away at your money's value. Today won't buy the same things 10 years from now. Investing allows your money to grow faster than inflation, helping you not just maintain your wealth but increase it over time. Think of investing as planting a tree. You water it, nurture it, and watch it grow. The sooner you plant, the larger and stronger it becomes. One of the most important concepts in investing is risk and reward. The basic rule is simple. The higher the potential reward, the higher the risk. This doesn't mean you should jump into risky investments blindly, but you do need to understand that some level of risk is necessary to grow your money. Low-risk investments like savings accounts or government bonds provide safety but only modest returns. High-risk investments like stocks or certain types of real estate can generate impressive gains, but they can also fluctuate in value. The key is finding the right balance based on your goals, timeline, and comfort level. Let's talk about stocks, one of the most popular forms of investing. When you buy a stock, you're essentially buying a piece of a company. If that company grows and becomes more valuable, so does your investment. Stocks can provide significant returns over time, but they can also be volatile. This is why many investors use a strategy called diversification, spreading their investments across different companies, industries, or even countries. Diversification helps reduce risk because it's unlikely that every investment will perform poorly at the same time. Think of it as not putting all your eggs in one basket. Another major form of investing is bonds. Bonds are loans you give to companies or governments, and in return, they pay you interest over a set period. Bonds are generally considered safer than stocks because you receive fixed payments and your initial investment is often protected if held to maturity. However, bonds typically offer lower returns than stocks. They're a good option for people who want stability or are closer to needing their money, such as those approaching retirement. Bonds can also play a role in balancing a portfolio, offsetting the higher risk of stocks. Mutual funds and exchange-traded funds are investment vehicles that allow you to invest in a collection of stocks, bonds, or other assets all at once. Mutual funds are professionally managed, meaning experts decide where to put your money based on the fund's goals. Exchange-traded funds work similarly but are traded on stock exchanges like individual stocks. These tools are particularly useful for beginners because they provide instant diversification and reduce the need for extensive research. They're a simple way to get started without having to pick individual stocks or bonds yourself. When we talk about investing, we can't ignore real estate. Property has been a wealth-building tool for centuries. Real estate investments can generate income through rent and appreciate in value over time. Unlike stocks and bonds, real estate is tangible. You can see and touch it. It can also provide certain tax advantages. However, real estate comes with challenges such as property maintenance, market fluctuations, and the need for a significant upfront investment. Despite these challenges, many investors consider it a vital part of a diversified portfolio. An essential part of successful investing is understanding compounding. Compounding is when your money earns returns and then those returns start earning returns themselves. It's like a snowball rolling down a hill, gradually gaining size and speed. The most powerful part of compounding is time. The earlier you start investing, the more time your money has to grow exponentially. Even small, regular contributions can turn into significant wealth over decades. This is why financial advisors often stress starting early, even if you can only invest a little at first. Now, let's touch on investment accounts. Your money grows differently depending on where you invest it. For example, retirement accounts like IRAs or 401ks in some countries offer tax advantages. Investments held in these accounts can grow without being taxed annually, which significantly boosts long-term returns. On the other hand, standard brokerage accounts offer flexibility. You can invest and withdraw funds freely, but you may face taxes on gains. Choosing the right account type depends on your goals, whether it's saving for retirement, a major purchase, or building general wealth. It's also important to have a clear understanding of your financial goals before investing. Are you investing for retirement, a home, your child's education, or just to grow wealth? Your goals will determine your timeline, risk tolerance, and investment strategy. Short-term goals often call for safer, more liquid investments, while long-term goals can tolerate more risk for the chance of higher returns. Having defined goals helps you stay disciplined and prevents panic during market fluctuations. Many new investors worry about the fear of losing money, and it's true that investments can fluctuate. Markets rise and fall, and investments don't always grow in a straight line. This is where mindset becomes crucial. Successful investors understand that volatility is normal and don't make impulsive decisions based on short-term movements. They focus on long-term growth and stick to their plan rather than chasing quick gains or fearing temporary losses. Patience and discipline often matter more than trying to pick the perfect investment. Another key concept is research and due diligence. While mutual funds and exchange-traded funds can simplify investing, it's still important to understand where your money is going. Researching companies, understanding economic trends, and staying informed about markets helps you make better decisions. Knowledge reduces risk and increases confidence, making investing less intimidating. Even basic understanding of financial statements, market cycles, and economic indicators can give you an edge. Investing isn't just about picking assets, it's also about budgeting and saving. Before you invest, you need to have a clear picture of your finances. This includes paying off high-interest debt, creating an emergency fund, and ensuring your basic expenses are covered. Investing should come from money you can afford to put aside, not funds you may need immediately. This foundation prevents you from making hasty decisions and allows your investments to grow without unnecessary stress. Automatic investing is a powerful tool to build wealth over time. Many platforms allow you to set up recurring contributions, ensuring that you invest consistently without thinking about it. This method not only builds discipline, but also takes advantage of dollar cost averaging. Dollar cost averaging is when you invest a fixed amount regularly, buying more shares when prices are low and fewer when prices are high. Over time, this strategy can reduce the impact of market volatility and smooth out your returns. Let's not forget about the psychology of investing. Emotions often lead to poor financial decisions. Fear and greed can make people buy high and sell low, the opposite of what a disciplined investor should do. Understanding your emotional triggers and developing a strategy can prevent costly mistakes. Creating a plan, setting goals, and sticking to it even during market turbulence is one of the most powerful tools an investor can have. Finally, always remember the power of learning and adaptability. The world of investing evolves constantly. New technologies, global markets, and economic policies can create opportunities or risks. Lifelong learning helps you stay ahead, make informed decisions, and adapt your strategy as needed. Reading, attending seminars, and following market trends are simple ways to stay informed and confident in your investment journey. Investing might seem complicated at first, but when broken down, it's really about a few simple principles. Start early, understand your risk, diversify, be patient, and keep learning. The sooner you grasp these basics, the sooner your money can start working for you instead of the other way around. Every decision you make now, no matter how small, has the potential to shape your financial future dramatically. So, what's the next step? Start small, but start today. Open an investment account, pick a diversified fund, and set up automatic contributions. Don't worry about timing the market perfectly or making huge investments. Consistency, knowledge, and patience are the real keys to long-term success. Every little action compounds over time, and before you know it, you'll be on the path to financial growth and independence. Investing isn't a luxury, it's a necessity for anyone who wants control over their financial future. It's not about luck, it's about decisions, discipline, and dedication. Understanding the basics gives you the foundation, but taking action is what turns knowledge into wealth. Remember, every wealthy person you admire started somewhere. They didn't wait for the perfect moment, so they educated themselves, started, and stayed consistent. You can do the same. Take control of your money today. Plant the seeds, nurture them, and let time work its magic. The knowledge you've gained now is your first investment. Use it wisely, and your future self will thank you in ways that compound far beyond just dollars. Start the journey today, because the best time to invest was yesterday, and the second best time is now.